Welcome to vTalkInsight, Risk Sentiment Daily for March 26, 2026. Equities are trying to climb even as energy markets still flash red, leaving risk appetite finely balanced today. Let us unpack what is driving this cautious risk-on tone and where the main fault lines now sit. Risk sentiment today is best described as cautiously risk-on. The S&P 500 gained a little over 0.5%, while volatility remains in the mid-20s, signaling that investors are adding risk, but still paying up for protection. After several sessions where global equities traded poorly and the index slipped below its 200-day trend, this bounce suggests some rebuilding of confidence, yet not a full return to complacency. The constructive side of the ledger comes from two places. Headline oil benchmarks have pulled back, with prices dropping below $100 and Brent off more than 4% at one stage, easing immediate fears of an energy spiral. At the same time, corporate fundamentals look surprisingly resilient. Earnings estimates for the S&P 500 have been revised up by about 2% over the past month, and analysts now look for high single to low double-digit growth, helped by strong technology and AI-related demand. Set against that, the macro and liquidity backdrop is still fragile. The Middle East energy shock has not been resolved, physical fuel markets in Asia and Europe remain extremely tight, and global surveys are flashing a mix of slowing growth and sticky prices. Stress in private credit and signs of rising risk aversion in government bond markets underline that this is a narrow, tactical risk-on rather than a broad-based chase. That leaves today's tone cautiously positive, but with unusually fat left tails if diplomacy or inflation disappoint. Resilient earnings and AI growth are a key pillar supporting risk appetite. Despite repeated macro shocks, from the pandemic to high inflation and aggressive rate hikes, U.S. corporates have continued to deliver. Forward estimates for S&P 500 earnings have risen from around 11 to roughly 12% growth, and revisions over the past month have been net positive even as oil prices spiked and geopolitical headlines worsened. Beneath the index, AI is emerging as a powerful structural growth engine. Chip designers such as ARM are targeting tens of billions of dollars in annual revenue within a few years from new CPU lines tied to agentic AI workloads, with shipments expected to start contributing this year. Memory supply is projected to stay tight over the next 12 to 18 months as AI inference models drive demand, while low-power architectures gain share in data centers facing performance per watt constraints. This combination reinforces the view that technology earnings have a long runway, even if the cycle is bumpy. This earnings and AI backdrop helps explain why equity markets can look through near-term volatility, treating drawdowns more as valuation resets than as the start of a deep profits recession. It also underpins interest in private equity, which offers more exposure to software and digital infrastructure than broad public indices. However, there are execution and capacity risks. Competition for advanced manufacturing slots at leading foundries is intense, supply chain bottlenecks are real, and higher energy costs threaten margins in sectors like airlines and chemicals. The durability of this bullish driver will hinge on whether companies can maintain pricing power and productivity gains as input costs stay elevated. De-escalation hopes and softer oil are another major support for today's fragile risk-on tone. Signs of potential high-level talks, a detailed peace proposal from Washington, and diplomatic pressure from Beijing have all fed the narrative that the worst-case conflict scenarios might be avoided. In response, headline oil benchmarks have fallen sharply, with prices dropping below $100 and Brent sliding more than 4%, while equities in Europe and the U.S. have staged relief rallies led by travel, leisure, and basic resources. Yet this apparent calm masks a striking disconnect between paper benchmarks and physical energy markets. In Asia, crude grades are still changing hands at $120 to $130 a barrel, jet fuel prices are quoted above $200, and gasoline near $150. Shipping through the Strait of Hormuz remains heavily constrained, with only selected cargoes moving and producers forced to shut in fields or cut refinery runs because storage is filling up. That leaves physical supply far tighter than headline prices suggest. For portfolios, This means the current relief rally rests on a very conditional assumption that diplomacy will move faster than the slow burn of supply disruption. Markets are enjoying lower benchmark prices today, but the delayed impact of tanker shortages, higher freight costs, and damaged infrastructure could still surface in the coming weeks. Investors will be watching closely for concrete steps such as a durable reopening of key shipping lanes, verification of any ceasefire, and signs that physical differentials are normalizing. Without that, optimism around softer oil could prove premature. Dry powder and rotation potential add another bullish dimension to the outlook. There is substantial cash sitting on the sidelines, particularly in the U.S., as investors have stepped back from volatile markets, but not exited the system. Insurance companies and other long-term institutions continue to receive steady inflows and see wider credit spreads as an opportunity to put money to work in higher-yielding assets, even as more tactical players stay cautious. At the same time, a rotation is underway within equities. There are early signs of a shift from large growth winners toward more cyclical and pro-cyclical sectors, with indices such as small and mid-caps expected to benefit if the cycle stabilizes. Emerging markets with strong semiconductor exposure, including South Korea and Taiwan, are preferred over Europe in some strategies, while European stocks have rallied on days when energy prices ease, boosting travel and consumer-related names. The key question is whether volatility and macro uncertainty can fall enough for this rotation to gain traction. Elevated implied volatility and rapid intraday swings driven by algorithmic trading are still deterring many long-term allocators. If geopolitical risks genuinely de-escalate and energy prices settle into a more predictable range, the combination of ample cash and a desire to diversify away from narrow mega-cap leadership could become a powerful tailwind. Until then, rotation remains more of a potential than a fully realized trend. On the bearish side, the Middle East energy shock and supply strain remain the dominant macro overhang. Physical flows through the Strait of Hormuz are still heavily restricted, with Iran allowing only limited cargoes, mainly to China and India, often in exchange for fees. Producers have shut in some oil fields, refineries have reduced output due to storage constraints, and fuel shortages that began in South Asia are now spreading toward Europe, prompting governments to consider demand management and emergency stock strategies. Price signals in the physical market reflect this stress. In parts of Asia, crude benchmarks trade above $120 a barrel, and some traders report paying up to $160 when risk premia around the strait spike. Transportation costs for energy shipments through the region have risen 4 to 5 times since the conflict began, while air freight rates from Asia to the U.S. have roughly doubled and then stabilized at significantly higher levels, embedding a lasting cost shock into global supply chains. If disruptions persist into April and May, several analyses suggest that oil price floors could end up $10 to $20 above pre-conflict levels, with any damage to infrastructure taking months or even years to repair. Sustained prices above roughly $115 would create serious inflationary and growth headwinds globally. Demand destruction may eventually cap the upside, particularly in price-sensitive Asian economies, but that comes at the cost of weaker activity. Energy-intensive sectors such as airlines, chemicals, and logistics are already facing margin compression, and the risk is that this energy tax becomes a drag on corporate profits and household spending worldwide. Linked closely to the energy shock is rising stagflation risk and the possibility of a more hawkish central bank stance. Recent global purchasing manager surveys point to a pattern of slowing growth combined with rising prices, particularly in energy importing regions. The euro area, as a net energy importer, faces a significant terms of trade shock, and there are growing concerns that what started as mild stagflation is hardening into a more entrenched mix of weaker growth and above-target inflation. Central banks are in a difficult spot. Scenario work at the European Central Bank suggests that under a severe energy shock, inflation could run close to 3 percentage points above target in 2027, with growth materially weaker until 2028. In that world, policymakers might be forced into multiple rate hikes if oil stayed above $120 for an extended period. In the U.S., Persistent inflationary pressures have already led markets to price out expected rate cuts for the second half of the year. The Federal Reserve is signaling a wait-and-see approach, still penciling in at least one cut over the coming year, but with the timing increasingly uncertain. At the same time, governments are leaning more heavily on fiscal policy to cushion households and corporates from energy shocks, driving larger and more persistent budget deficits. In the U.S., deficits could reach 8 to 10% of GDP, especially if military spending rises, raising questions about long-term debt sustainability. The combination of sticky inflation, constrained central banks, and expanding fiscal deficits points toward upward pressure on long-dated yields and a challenging backdrop for traditional stock-bond diversification. Lower-income households and energy-intensive sectors are likely to feel the strain most acutely, which could in turn feed back into political and policy volatility. Finally, liquidity and private credit stress are emerging as important downside risks. Portfolio managers are rotating out of more volatile segments, such as emerging market debt, and into short-duration U.S. Treasuries, seeking to lock in attractive yields while reducing exposure to geopolitical and rate swings. Recent Treasury auctions saw dealers forced to absorb their largest share since 2020, with yields rising as investors demanded more compensation, a sign that risk appetite and market-making capacity are under strain. In private credit, redemption caps and withdrawal limits are being tested. Several large funds have imposed 5% quarterly gates, and recent episodes have seen more than $1 billion of redemption requests blocked, highlighting the tension between daily sentiment and semi-liquid structures. Family offices and high-net-worth investors are at the forefront of these outflows, often driven by a desire for liquidity and a reassessment of how these products behave under stress, even as some institutional investors continue to allocate. There is an important nuance. Net flows in parts of the private credit universe remain roughly balanced as fresh inflows offset withdrawals, and insurance companies view wider spreads as an opportunity. That suggests ongoing demand for the asset class, even as fundraising for new vehicles becomes more challenging. Nevertheless, the combination of elevated equity volatility, concerns about market integrity around geopolitical headlines, and tighter credit conditions raises the risk of a negative feedback loop if liquidity were to deteriorate further. Monitoring redemption activity, bid-ask spreads, and funding costs will be crucial for gauging whether this stays a contained pocket of stress or evolves into a broader constraint on risk-taking. To sum up, today's picture is one of cautious risk-on. Softer oil benchmarks, resilient earnings, and powerful AI-driven growth themes, together with ample cash and rotation potential, are providing a floor under risk assets. But that foundation sits on top of an unresolved Middle East energy shock, rising stagflation risk, and growing liquidity and private credit strains, all of which keep downside tails wide and make the path for markets highly headline-dependent. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.